Hello, we're back. I was pretty busy today, so I didn't have time to do any recordings today. Uh, so here we are on Thursday evening. It's about 11 p.m. And let's see if we could continue with our problem from last night. Let's see. This problem here. Problem 4-2A. So last night when I ended and exited, I simply saved and exited from the problem, and so we should be able to continue on with the same attempt, which was attempt number 1. And so let's press continue. In progress. Current attempt 1 of 3. Click on continue, and let me get our Excel notes that we were working on last night. Here I saved them. Here they are. And again, these calculations on this Excel spreadsheet are, just informal calculations, not required by the problem. But of course, you'll probably be doing your own calculations, be it with a program like Excel, electronic spreadsheet program, or pencil and paper. But anytime you're working with numbers, you definitely are going to be doing calculations. And of course, I've used electronic 10-key calculator pretty much probably the past 55 years. It's crazy. I remember the first electronic calculator I bought when I think I was a junior in college, and it was pretty cool. It was a Toshiba electronic calculator, no printout, just a readout on digital readout on the screen, and it was battery operated, and of course there was a power cord. I think it cost me like $350. It was a crazy price. But I've been using these calculators for work since then. And if you don't have one now, we have electronic calculators in our computer classroom at the college. I'm not sure if any of you have already taken a course there, but we do have electronic calculators for students to use. I think we still have a course that teaches basic calculation and calculations and calculator techniques. I think it's a 1-credit course, but it's definitely a skill that you need if you're working with numbers for sure, and pretty much working in an office environment. You're bound to be working with numerical data at one point in time or another. But anyway, let's pick up where we left off. Let me get this out of the way here. Our spreadsheet, oops, didn't want to do that. Spreadsheet is still here. And, oh, look, total in the debit column for the unadjusted trial balance showed up. I wonder what the heck's going on with that. It should have been there to begin with last night, just as it is on the unadjusted trial balance up above in the problem data. So here it is again in our solution, our worksheet solution. And we had done adjustments A and B last night. A was to record the adjustment for supplies used. That adjustment, based on our calculation, where's our spreadsheet here? Let's get this thing reduced in size a bit. Calculation based on a beginning balance and an ending balance as provided in the problem. We subtract the ending from the beginning to get the amount of supplies used. Now, supplies used would generally be recorded as a supplies expense. And let me move this down one space. So supplies used would be a debit to supplies expense with an offsetting credit to the asset account supplies. So again, our supplies expense, we start out with a zero balance, and our expense adjustment is 6,080 based on our calculation. And so the balance in supplies expense after adjustment is 6,080. So, and the way it works is simple addition. There's simple addition and subtraction moving from left to right, from the unadjusted to the adjusted trial balance. We move from left to right, and we consider any adjustments that affect any account that we are working with. As we move from left to right, we start out with zero in the debit column, since supplies is an expense. And let me get that handout that we were working with. Supplies is an expense, and I'm sorry, supplies expense is an expense, and supplies, which reflects the amount of supplies that we own, is an asset account. And so this adjustment essentially moves a certain amount of this asset account over to expense as it's used up. So we started out with supplies of $9,500. And by calculation, we use 6,080, which is a credit to the asset account. So we have a debit of 9,500, and we subtract our credit of 6,080 to come up with our adjusted trial balance amount, which is our ending supplies account balance of 3420. So the way I have it on the in the calculation here is a little different, based on the amounts that we were given in the adjustment. So the adjustment told us that the ending balance of supplies was 3420, and by referring to the trial balance itself, unadjusted, our supplies before adjustment was 9,500. So again, our calculation can be performed by subtracting the ending balance given from the beginning balance given, and the difference is going to represent the amount of supplies that we used for the period. And I believe we're looking at the year, yeah, from July 1, 21 to June 30, 22. Okay. So, and again, every transaction, including adjusting transactions, must have a debit and a credit, and those amounts must be equal. Our second adjustment was for expired insurance. And so when we pay for our insurance premium up front, let's say we're paying for a period of a year at a time, initially we end up with an asset account called prepaid insurance. You might wonder why we don't end up with insurance expense when we pay our premium at the beginning of the year. Well, the way accrual accounting works is we initially record this prepayment of our insurance premium, and in this case would be for a period of a year, record it as an asset. And an asset, if we refer to our handout here, an asset is something of value owned by the business. And an asset generally is purchased in order to help generate revenue for the business. So, and most assets over time end up being used up. And as an asset is used up, the amount of that asset is recorded as an expense. So if we had an asset, let's take a look at our prepaid insurance. We pay for our insurance, our annual insurance premium at the beginning of the year, $6,000. And we can say that this insurance this prepaid insurance, this insurance coverage is going to be used up at the rate of 1/12 each month for 12 months. And so we could be doing monthly adjustments, in which case we would, if we're doing monthly adjustments, we would have, let's say, insurance premium paid 7/1/21, that's $6,000. Our period of coverage, let's say, is 12 months. So our, let's call it a ratable usage of insurance. We would take our premium amount and we would divide it by the number of months that premium covers. So that would give us a usage of insurance over 12 months at the rate of $500 a month. And our entry, our journal entry to record that, would be a debit to insurance expense and a credit to prepaid insurance. And so this is not what the problem is asking us for, but I just wanted to show you this calculation as an illustration. So again, if that were the case, then this $6,000 would be reduced by $500 every month. We would credit prepaid insurance $500 each month. We would credit it $500, and we would debit insurance expense for $500. And over a period of 12 months, our prepaid insurance account would have been credited in a total of $6,000, 500 times 12. The total credit over 12 months would be $6,000, and our adjusted trial balance amount at the end of a year would be zero for prepaid insurance. And conversely, we would add to insurance expense at the rate of $500 a month every month for 12 months. And so at the end of 12 months, our insurance expense balance would be $6,000. So our asset of $6,000 over a period of a year in this example would eventually end up as insurance expense of $6,000. Okay, but again, in our problem, we have our beginning balance on our trial balance, and they are giving us not the ending balance, but the amount of expired insurance. So this is going to be the amount of insurance used up for our year. And so we want to credit our prepaid insurance account, which is an asset. We want to credit it for the amount of insurance expired or used up. And the difference between our beginning balance and the amount used up is what we have left at the end of the year, 2220. Meanwhile, to offset our credit to prepaid insurance of $37.80, based on the amount given to us in the adjustment, our offsetting debit would be to insurance expense of $37.80. Our insurance expense account starts out with a balance of zero pre-adjustment. Our adjustment is a debit of $37.80, and so 0 plus $37.80, we end up with a adjusted trial balance amount for insurance expense of $37.80. And again, I just repeated what we talked about last night for these first two adjustments. So let's move ahead with adjustment C. Annual depreciation on equipment is $8,400. Now, depreciation is a topic that's covered in a chapter unto itself. I believe it's covered in chapter 10 in our textbook, so I won't get into a long, drawn-out explanation of depreciation. Let me say this about depreciation. If we have long-term assets that are used up over a longer period of time, longer than 1 year, like equipment, and to show that that asset is being used up over time, we record that expense. In this case, for equipment, we don't record it as equipment expense. Rather, we record it as depreciation expense on equipment. So it's just, as far as the account title is concerned, it's strictly terminology. Okay, so this depreciation expense, for purposes of where we're at in chapters 3 and 4, we'll say at this point in time, we'll say that depreciation expense shows that our asset is being used up in the amount of the depreciation for our period of time, which in our case, in this problem, is a year. So again, let's go back and look at that adjustment. Annual depreciation on equipment is $8,400. And so we need to record depreciation. Let's show the accounts and the amounts for our equipment. Our equipment balance is $148,150. And another account that we use for long-term assets like equipment is a contra asset account. And again, we'll study this in depth when we get to chapter 10. And that contra asset account is called accumulated depreciation. And in this situation, it's on equipment. Our balance pre-adjustment or unadjusted trial balance amount for accumulated depreciation is $29,000. And this is a contra asset account, which essentially, the term contra asset essentially means that whereas an asset account carries a normal balance that is a debit, if an account is a contra asset account, then what that means is that that account carries a normal balance that is a credit. Okay, so I'm not showing contra asset accounts in this handout here under assets. I'm just showing assets, and assets carry a normal balance that's a debit. But there are accounts excuse me, called contra asset accounts, which carry a credit balance. And so in our problem example, our accumulated depreciation balance on equipment is $29,000. And the difference, by the way, between our equipment account balance and our accumulated depreciation on equipment account balance is called the net. Just giving this to you so that you know what the terminology is, but again, we'll study this more in chapter 10. And so to get the amount of the net book value, we take our equipment and we subtract our accumulated depreciation on equipment, and that gives us our net book value of $119,150. Of course, our adjustment is simply to record depreciation for the period, in which case, in our situation is a year. That amount is $8,400. So let's just show it here. Depreciation expense, and let's not forget this is on equipment. $8,400. And so our entry to record depreciation expense is recorded debit to depreciation expense and a credit to accumulated depreciation, and in our example on equipment. And that would be the adjustment to record the depreciation expense on our equipment. And again, this is strictly to show the adjustment as part of what we are learning in chapters 3 and now in chapter 4. So let's show that as an adjustment here to depreciation expense in the adjustments column in the debit column of the adjustments columns, $8,400. And the offset, as we noted in our calculation, whoops, I keep doing that, and that's not what I want to do. That is accumulated depreciation, and that's a credit adjustment. Again, just like the two previous adjustments, we have a debit and a credit, and they are equal. Let's go to adjustment D. This one gets a little bit more complicated, so let's take a look at it. June utilities expense of $530 is not included in the unadjusted trial balance. So we have unrecorded utility expense. And the reason is because the bill arrived late. The bill arrived after the trial balance was prepared. And then it says the $530 amount owed must be recorded. So we owe this as part of our utility usage or utility expense for our accounting period, which again is July 1, 21 through June 30th, 22. This particular bill for $530 is for our current year that we're working on, but the bill arrived late, which happens a lot when we're in business, or even for personal bills that we deal with on a monthly basis. And so we need to record this as expense for the current period. So I don't think we need to do a calculation on that. The expense is for utilities, and so we can find our, and utilities, by the way, does have a balance in it, but it's too low by $530 because we didn't have that bill when we prepared this unadjusted trial balance. So we debit utilities expense, and this is an example of an accrued expense. So an accrual generally is a recordation of an item that affects the current accounting period but has not been recorded. And so to offset this expense, we haven't yet paid for it. In fact, we received the bill late. We haven't yet paid for it, but we owe it. And so if we take a look at our accounting equation, we can see that an amount owed by the business is a liability. A liability is an account that carries a normal balance that's a credit. And so that makes sense. If we're debiting utility expense, we need to credit an account that says we owe those utilities, or we owe that expense. And so we would probably call that account utilities payable. And so we need to look at our trial balance and see if we have an account called utilities payable, and we don't. So we would probably best categorize our utilities payable in this account and record it in this account as accounts payable. Accounts payable generally would represent expenses of the business that occur on a regular basis, generally monthly. And initially, and accounts payable generally are payable on a 30-day cycle. So if we buy something on account this month, we would, debit some expense or maybe an asset and credit accounts payable. And our accounts payable would generally be paid 30 days later or 30 days from purchase date. So initially we would record these utilities or this utility bill as accounts payable. Okay, now we also need to calculate or move the amounts from our unadjusted trial balance columns over to our adjusted trial balance columns, but we can do that after we're done recording all of our adjustments for the period. So again, for our utilities, we debit utilities expense $530 and we credit accounts payable. If we did have a liability account called utilities payable, then we would use that account. But in this case, we're just going to show it as accounts payable. All right, now adjustment E, employees have earned $1,400 of wages at June 30th. And those wages have not yet been paid at June 30th. Neither, according to the adjustment, neither have they been recorded, which means that they are accrued but unrecorded, and so we need to record them. So our entry to record accrued wages payable, wages expense and accrued wages payable of $1,400 would be to debit wages expense of $1,400 and credit wages payable $1,400. Notice as we add adjustments to our adjustments columns of our worksheet, the totals in our debit and credit columns continue to grow, and they should always be equal. Okay, next adjustment would be adjustment F, rent expense incurred but not yet paid or recorded. Here we have another unrecorded expense for an expense incurred in the current accounting period, in the current year, July 1, 21 through June 30th, 22. It's been incurred. In other words, occupancy of the premises for which we pay rent has happened in the current accounting period. Okay, so we owe the rent for this period, but we haven't recorded it, and so we need to accrue it, which means we need to record it as expense and as an amount that we owe. So just as we've done for the previous two adjustments, our rent of $400 would have to be recorded as a debit to rent expense, $400, and a credit to rent payable, $400. Let's get back up here to adjustment G. Additional property taxes of $800 have been assessed for this fiscal year. So the tax department or the tax office you own property, and this applies to businesses as well as to individuals. If you own property, generally the governmental unit, which in this case is probably the county or the state. In Hawaii, taxes are assessed by the various counties. So for the Big Island, it would be the county of Hawaii. So the assessment is made to charge the property owner with real property taxes. In this adjustment, additional property taxes of $800 have been assessed for this fiscal year, but again, not yet paid and not recorded at the end of the fiscal year. So we need to accrue property tax expense and property tax payable. And let's see if we have those accounts, and looks like we do. Property tax expense, and that was the amount of $800. Property tax expense of $800, and property taxes payable of $800. And as we continue to add adjustments, our adjustments column of our worksheet continue to get larger, and our debit balance total and our credit balance total are equal. And the last adjustment, H, $250 of accrued interest for June has not been paid or recorded. So we need to show that we have incurred interest expense of $250, and at the same time we owe interest payable of $250. And so we would record our expense of $250 and our payable of $250, both accounts for interest expense and interest payable. Now we have gone through adjusting information, and we've recorded our adjustments on worksheet in the adjustments column. Now, the next step generally would be for us to transfer all account balances from unadjusted to adjusted, taking into account any adjustments made for our current period. And so this becomes exercise in addition and subtraction. So our cash balance starts out with a debit balance of, our cash account starts out with a debit balance of $16,000, no adjustments, and so we end up with a debit balance of $16,000. We've already done supplies, we've already done prepaid insurance. Equipment, we start out with a debit balance of $148,150. No adjustments directly to the equipment account, so we end up with a debit balance of $148,150. Depreciation, accumulated depreciation, we start out with a balance of $29,000. And let's see if we can show this here. Accumulated depreciation let's call it what the problem calls it, which is the correct terminology, and that is unadjusted. So $29,000. And our depreciation expense $8,400. So our accumulated depreciation adjusted would be $29,000 plus $8,400. And keeping in mind, this is a credit balance. So the amount of our adjusted balance for accumulated depreciation is $37,400, and it's a credit. Accounts payable, we started out with $6,200, and accounts payable is a liability. It's a credit balance account. We added $530, and I'm just going to do this one by taking 62 and adding 530, so that's 6,730. Our interest payable, we started out with 0. We added 250, which was a credit. Same for rent payable and also wages payable and property taxes payable. And for all of these 4 accounts, we start out with 0. We add a credit of 250 to end up with a credit balance of 250, and same for the next 3 accounts. Our long-term notes payable, same thing. We start out with a balance of $25,000, no adjustments, and we end up with a credit balance of $25,000. Oops, $25,000. Our capital account. At this stage of our worksheet, we simply move this amount over from the unadjusted credit column to the adjusted credit column in the amount of $77,700. Same for the drawing account. $33,000. Drawing account is a debit balance account. Then we get into our revenues and expenses. Our revenues, again, revenues are recorded as a credit in our revenue account. And revenues are amounts that the business earns by providing a service or product or both. Okay, so our revenues were $143 unadjusted, and they remain at $143 because we have no adjustments to our revenue account. And then we have all of our expense accounts, so we can bring these over one at a time. 0 plus 8,400 is 8,400. Notice expenses are all debits. Wages expense start out with a balance of $43,000 in the unadjusted column total. Our adjustment to wages was $1,400, so our adjusted balance is $44,400. Interest expense, $2,750 debit plus $250 debit is $3,000. Insurance expense, we already did this one. 0 plus $3,780 equals $3,780. Rent expense, $11,000 debit plus $400 debit is $11,400 debit. We already did supplies. Property tax expense, we start out with an unadjusted balance of $5,000, which is a debit. Our adjustment is an $800 debit, and so our adjusted balance is $5,800. Repairs expense, no adjustments. And utilities expense, we start out with $3,800, and we have a debit adjustment of $530. And so we take $3,800 and we add $530, and that balance is $4,330. Notice, after carrying over all of our from our unadjusted columns to our adjusted columns, taking into account all of our our adjustments in the adjustments columns. Our adjusted trial balance column totals, debit column total, credit column total are equal. And I think we should wrap this up at this point. All of our adjustments have been recorded on our worksheet. Now, we still have a lot of work yet to be done. All we did under required was step 1. And so we still have a lot of work to do. We need to journalize each of our adjusting entries. You know, we just recorded them on our worksheet. We still need to journalize them. In fact, maybe we can do that. Let's see. Why don't we do that? Take care of that. This is going to take a little bit of time, especially if to refer back to our worksheet, or refer to, maybe it's easier if we just refer to our adjustments noted in the problem above. So adjustment A, let's see if we can do it that way. Supplies available at the end of the current fiscal year, total 3420. Well, let's go back to our calculation here and get our supplies used of $6,080. Oh, let's go back here for a second and check our work. Lo and behold, everything's correct. So let's not forget to check our work as we go. So requirement 2 is to journalize each of these adjustments. And again, our supplies adjustment is to show supplies used of $6,080. And so our debit account would be supplies expense, $6,080, and our credit account would be asset account supplies, also $6,080. I believe, I think we need to show, no, we don't need to show journal entry explanations. So that should be good. Let's record that entry. For adjustment B, cost of insurance, expired insurance is $37.80. And so to record our expired insurance, we debit insurance expense for $37.80. Credit our asset prepaid insurance $37.80. And let's record that entry. For adjustment C, annual depreciation on equipment, $8,400. Now I'm going through these fast because we've already spent some time when we looked at each adjustment and recorded each adjustment on the worksheet. So at this point in time, all we're doing is we're journalizing each adjusting entry in the general journal. So let's record depreciation expense on equipment of $8,400, and the credit account is that contra asset account called accumulated depreciation on equipment $8,400. Let's record that entry. Adjustment D is for June utilities expense accrued $530, and so we have a debit to utilities expense of $530 and credit. Now we don't have a utilities hit, So again, we already talked about this. We're going to record that as accounts payable of $530. Record that entry. Adjustment E, record accrued wages of $1,400. So these would be wages incurred, wages expense incurred, wages expense incurred, $1,400. Wages payable, $1,400. The accrual of unpaid and unrecorded wages. Record that entry. Transaction or adjustment F, rent expense incurred and not yet paid or recorded, so we need to accrue rent expense of $400. Debit rent expense $400, and credit rent payable of $400. Record that entry. Transaction or adjustment G, additional property taxes of $800 need to be accrued, not paid, not recorded. Property taxes expense of $800, offset by a credit to the liability account, property taxes payable of $800. Record that entry. And our last adjustment, adjustment H, $250 of accrued interest expense and payable. So we need to record our interest expense of $250 as a debit, and interest payable, our liability, as a credit. Record that entry. Let's take a look at our general journal, which would show us all of our adjusting entries that have been journalized. And let's check our work. We see that we're okay, and we can return to the problem. And now at this point in time, since we've actually journalized, we've recorded all the adjustments in the worksheet. And we've also journalized all of the adjustments in the general journal. Let's wrap this recording up and get this posted and sent out to everybody. And it's about midnight right now, so I'm going to continue with the next part of this problem solution video tomorrow. All right, hopefully this will help you get through this problem 4-2A. Aloha.